one of the worst destructive forces in investing is emotion. And we all suffer from it. One doesn't want to be an automaton or Robotron or what have you. We have to invest with emotion and understand other people's emotions, quite frankly. It is emotional decisions that are often the most destructive. So setting one stall out at the beginning and taking people on that long-term journey, I think is really important.
Find out how our next guest pursues profit and purpose at the investment helm of one of the UK's largest local government pools. I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by David Vickers, who is Chief Investment Officer at Brunel Pensions Partnership Limited, which manages assets on behalf of 10 partner funds within the local government pension scheme, representing about £30 billion. He has extensive experience in investing in the multi-asset arena, where he has spent time managing assets for a range of institutional investors. Welcome, David. Thanks for joining me today.
Thank you for having me.
Can we start with your journey into investing? And can you tell us where you grew up, what you studied, and how your career started?
Yeah, of course. So I grew up where I'm sitting today, actually. So I grew up in Essex. So really kind of within semi-touching distance of the city. And I think that's probably one of the reasons I ended up in this industry, because it always felt like an option. I saw other people ploughing that furrow, if you like. And so as opposed to growing up somewhere else in the country where you don't perhaps have those touch points, it always felt like a potential option for me. But my parents were both teachers. My dad taught at a technical college and my mum taught at the secretarial college. Although actually, interestingly, both of them taught at a prison as well. They did night classes to earn a little extra money to raise myself, my brother and my sister. So they weren't in this industry. But I think growing up wrongly and perhaps naively, it looked very glamorous, as slightly everything does when you're 17 and 18 and making those choices about what you want to do with the rest of your life. But even the collapse of Barings, as I was kind of finishing off my A-levels, didn't put me off. Indeed, I actually ended up working at Barings for a period of time in my earlier career as well. But I think probably the part of my life that cemented my desire with a bit more thought around it actually was my first taste of working on a trading floor during some work experience I did for American Express. And just the buzz, the intensity, just the cut and thrust of it at that stage, I kind of really cemented my view that whilst I might not want to move into trading, something in the financial industry seemed to be in my sights.
And it's funny, the collapse of Barings, it only kind of adds to the drama and some of the excitement, I think, when you're watching that as an observer. It doesn't surprise me that it didn't put you off.
No, and I think that's it, isn't it? It looks exciting from the outside, and I certainly wouldn't want to have been working there when it happened. It always feels very different when you're in the inside than when you're on the outside looking in.
And fast forwarding now to your role as Chief Investment Officer, what were the steps as that came about?
Yeah, so as I said, my first role actually out of university, I'd gone around the milk round interviews and I'd found myself at a reasonably moderately sized kind of asset manager / wealth manager / stockbroking firm, really. And I was eventually looking after kind of private banking clients, albeit reasonably sizable ones. And increasingly, I think there were lines of demarcation around, do you want to be a relationship manager, a private banker, or do you want to follow the assets and manage the assets? And I think quite early on, I realized actually my heart lay in managing money. And so actually, when I went to Barings, it was a bit of a halfway house in that they had some very significantly pseudo-institutional sized mandates because of who Barings was. And so we had a lot less clients, but more sizable ones with greater sophistication and levels of advisors and consultants in between us and the end client. And so that was really the turning point for me, that I started managing money. And then I moved to Saracen and Partners and ultimately to Russell Investments before I finally found myself at Brunel, really managing, and I've always managed multi-asset portfolios. At Saracens, it was mainly those, I used to run some UCITS funds and some very large endowment programs. And then at Russell, it was very much in the pure institutional world of sovereign wealth funds, insurance firms, and fiduciary management OCIO mandates. But again, usually through the vehicles of running a multi-asset UCITS fund or a number of very large segregated portfolios that were built on that same reputation. And then about a year ago, I decided I'd like to try something a little bit different, still obviously within the sphere, but I'd got to a stage where I was starting to enjoy more and more managing people, shaping teams, thinking about process, thinking a bit more strategically than perhaps actually running money allows you to do. And the role at Brunel came up. And at the same time, I had a yearning to go back to kind of an asset owner, where actually I didn't have to go on the road marketing my services. And because I was feeling slightly the curse of the head teacher. You might have been an okay teacher, so you become a head teacher, and then you teach a little less, as it were. And I wanted to get back to a role where I really could shape the destiny of one or a number of clients, not a whole range, and not have to do the marketing part of the role. Yeah, over the years, I'd really started to enjoy mentoring and building teams and setting a process. And I guess the other opportunity that was really exciting to me is moving back into a field of sustainable investing. Because when I had been at Saracens and running money for endowments, lots of them had been the front runners of what we now know of ESG. So they all had their own personal mission statements, be it religious or charity orientated. And I really wanted to get back to that world where I felt I could marry my values with my passion for managing money.
We're certainly going to talk a little bit more about that later on. Before that, though, I just wanted to ask about any core investment beliefs that you've taken through the different organizations you've worked at.
I think a little bit from everywhere I've been and from everyone whom I've touched or worked with. And I was thinking about this, that the one word that I think sums up how I think about investments is being pragmatic. It's that word pragmatic, because I don't think there's one right answer to how you should invest. I think every person, every institution needs to be flexible, and that their investment process, the one that's right for them, should reflect their experience, their resource, their governance structure, and really ultimately be aligned with their definition of success, which includes their time horizon. So I don't think there's a one-size-fits-all answer. Now, clearly being aware of the range of different payoff profiles of the differing investment approaches you can take is critical, because one needs to avoid disappointment and arguably the inopportune changes to strategy, which can lead to permanent impairment of capital. But I think the big thing that I've really learned and taken with me, and I'm a huge believer in, is process. It really helped me when I was directly managing money. It's helped when I'm judging other managers, and now it helps me when I'm managing the team. To perhaps misquote James Montier of GMO, you can't quality control the outcome. We are dealing with imperfect information and incomplete knowledge, so it's very difficult, but you can quality control the decision-making process. And it's that process that allows you, if you get it right, to be consistent and to be robust and to make more often than not better decisions with the information you have at hand at that point in time.
And taking that philosophy now into your role as CIO at Brunel, what's at the forefront of your mind? What are your priorities today?
Yeah, I think we're very lucky in Brunel in that the partners that we have, the local government partners, already had a great deal in common and a great deal of crossover even before pooling was a twinkle in George Osborne's eye. And so actually, we are already a very long way through the transitioning process, which is the process by which the underlying pension funds pass the management of their assets over to us. So I don't have to and haven't had to build a business and build an asset management team and the governance, because when I joined a year ago, it was already in formation. So for me, my challenge is much more forward-looking. And the question probably is centered more around how can I evolve our products, our services, and arguably our advice to ensure that our partners have the best possible chance of achieving success and meeting their fiduciary responsibility. And if I think about that with an investment lens on, it really means helping them think through the potential paradigm shift that arguably could be occurring today as we leave behind maybe 30 years of declining rates and a disinflationary environment driven by globalization of supply chains and labor and demographics, at the same time as the world is grappling with profound changes of moving away from fossil-related energy sources, which is an enormous capital shift, perhaps the likes of which we certainly haven't experienced, certainly in my career, but for maybe the entirety of the last 100 years since the Industrial Revolution. So going through those challenges and making sure we're best equipped to help our partners progress successfully through these changes is really important. And then I think we have the more immediate challenge, potentially, which is around net zero. So how are we thinking about evidencing and measuring and monitoring our progression towards a net zero portfolio and a net zero world? Because the science is still evolving. The technology on which lots of the net zero progression is relied upon has not yet come to fruition, or at least is not yet commercial or viable. From a company perspective, the data isn't where it needs to be. Where it is available, it's not homogenous. And then there's the fact that there's going to be trade-offs and nuances that aren't neatly captured in the data, even if we could present it in a one-figure number. So there's lots of communication and education, I think, around this progression piece towards net zero as that commitment fleshes out into real action. A great example of the nuance perhaps is a company we own called Ørsted, which is, I think, the world's biggest renewable generator. When you look at it on some metrics, it scores quite badly because it's quite carbon intensive. Its blades and its wind generation units are made of steel. We haven't yet got to a world where they can be made of paper mache. So a lot of steel goes into the generation of power, but arguably it's a force for good and not for bad. But on that one single data point, it can flesh out quite badly. And that's why I don't think the data is going to capture all of this. So it'll be a nuance, it'll be examples and communication and a narrative around those numbers. I think that's going to be very important. And I think that's the journey we're all, as an industry, hopefully going on.
And Brunel has always been at the forefront of this, even getting back to its origins and the Environment Agency. What are you doing now in terms of, I know that you participated last year in a product launch around sustainable investing. If you can talk a little bit about that.
Yeah, of course. So late last year, we launched with FTSE Russell a series of Paris-aligned benchmarks. What we wanted to do was provide our partners with the option, should they wish it, to be passive and to be Paris-aligned. It shouldn't be an either or. If you want to be passive, you should also be able to move towards your net zero commitments. And when we looked in the marketplace at potentially the benchmarks and the indices that were out there, we found lots of them to be slightly suboptimal, particularly in the way they dealt with finance companies, actually, because they typically were kind of low carbon-esque. They often weren't forward looking and take into account really the transition element of the transition to net zero. And they'd often be underweight fossil fuel companies and overweight banks. And banks, as you know, are very much in the supply chain of the transition because they are funding some of the energy companies that are both listed and the corporations that are unlisted. So you need to tackle both. So with FTSE, we work to create a series of UK and global indices, a franchise really, that enabled our clients to be passive and fulfill their commitments. And it was really interesting, actually. We put our kind of sustainable or responsible investing knowledge into the pot. FTSE obviously came at it from their index experience. And we create indices that have Paris alignment at the heart of them. So they have targeted reductions in both carbon reserves and operational emissions, an upfront reduction, in most cases of 50%, and a 7% year-on-year reduction after that. We are targeting within them an uplift into green revenues. We have activity-based exclusions on kind of oil and coal and electricity generators. We also then have, which I think is the important part, more forward-looking metrics. So every corporation that forms part of that index is scored both on their intentions, stated intentions around transition, but also on the quality of their management and the credibility that those commitments have. And thus the indices are tilted. And they are forever changing. And we hope that lots of the companies that don't find themselves in the index today will eventually find themselves in the index. And what was really important for us, and it was, I think the work had started before I joined, but I think it's one of the biggest things that Brunel have been proud about, I think, over the last number of years, which is we created this indices with FTSE Russell. We remain on the Constitution Board, so we have a hand in how it evolves. But we had a £3 billion launch just from our own partners. And it's rather a flagship for other people to then use as well, because it's all well and good if we can altering the outcome of the Brunel portfolios, but we're only 40 billion today. That's a lot of money, clearly, but it's not enough. It's not enough when you think about the world of asset management. And what we really strive to do, as well as changing our own outcomes, is change the outcomes for other investors, for other institutions, so that ripple effect goes much, much wider. And then on these indices are open for anyone to use and follow. So we try and set a trend, show people the way, if that's not too arrogant a thing to say, and hope that people use the same indices, and so that they can also be passive and pursue their own net zero ambitions.
It's interesting because often the barrier to doing this for many is the time and effort involved in actually going through the index with a fine-tooth comb and making these assessments of value judgment, as you mentioned. So I guess a lot of that is upfront, which you've now done, so can hopefully scale. Obviously, quite a bit of it will be ongoing as well.
Yeah, exactly. It will. And when I joined Brunel, what I found is that everyone's commitment to net zero or just a more sustainable world is intrinsic to who they are. I've got people in my investment team who want to scratch the investment itch, but also want to do something with purpose and with passion. And many of us in our evenings spend time lobbying the government or sitting on particular boards. And myself and some of my colleagues, we sit on some working groups with PRI. I sit on the GFANTS, the Mark Carney group, around transitioning to a real world economy. And so we're lobbying not just for Brunel, but for the wider industry. And clearly, as you're probably aware, Faith Ward, who's my Chief Responsible Officer, chairs the IIGCC, so the Institutional Investors Group for Climate Change. And so these aren't pro bono things. Obviously, it has a benefit to Brunel and our partners, but actually we're trying to push this out into the wider world because we're aware that just changing our £40 billion pot, as I said, isn't enough. We need to make real economy changes. And it is upfront work. It's continuous, but everyone at Brunel kind of stands behind that. And a strapline, for what it's worth, is investing for a world worth living in. And that really does run through all the people I found at Brunel, which is such a nice thing.
And looking forward now, I don't want to let any genies out of bottles, but it would be great to hear how you think these products will continue to evolve beyond perhaps passive products into maybe specific, whether it be private assets, climate tech, climate solutions, impact-based products. How do you see the next 5 years looking in terms of product launches?
Yeah, it's interesting. So I get asked this question quite a lot as regards usually towards listed markets. And with listed markets, clearly you can only invest in the universe that is there for you. And we have a sustainable fund that really does tilt towards solutions-based companies. And more of them are coming to market or being developed, but there's still not as many as one would like. Where we find that we can be more impactful with our money is really in the private market space. It's really in infrastructure, in private equity, in private debt, where you can support businesses that aren't listed, that are trying to come up with or indeed have the technology already developed and they're trying to commercialize it for a better world. And so one hopes that eventually the timeline would be that those private companies perhaps become listed and then the listed market franchise can start to get access to them. But at the minute, most of the impactful work, I think, that we can do is in the private market sphere. And so it's starting there. All of our portfolios in the private markets world, way back when, have always had a very significant kind of ESG overlay. And that runs through us like a stick of rock before it's perhaps commercial to think about it in those terms. And some of the successes we're having are significant. We have, for example, we back a series of greenhouses in East Anglia that are heated, sounds a little bit unpleasant, but are heated through from the heat from a local sewage plant. It allows us something like 90% less water used. The crops can be grown all year round. We can grow things that perhaps don't grow in the UK quite as readily as they might elsewhere. So you cut down on the carbon footprint of peppers and the like and tomatoes. And it's just a really good example of the type of things we can do in private markets where we have the support and the incentives from the governments to do so also, because that's obviously very important as well. Lots of these projects are not as commercial as they need to be without government support and incentives.
And just a little bit more crystal ball gazing before we go back to personal reflections. Looking outside some of these solutions or some of the sustainable investments we mentioned, maybe looking at other asset classes, how you see your portfolio evolving from an asset allocation standpoint. We've seen the levelling up initiative being discussed. Do you see Brunel perhaps offering more infrastructure options, more local investment impact options?
Yes, potentially. So the way it works at Brunel is that the underlying partner funds have responsibility for their asset allocation. And so they come to us with a request, so to speak, and we advise them on it and discuss it with them. But ultimately, the specification of the products they want lies with them. But it's interesting. We have had lots of infrastructure historically, and other clients have at least, and we've designed those products, but they've been quite global. We have got a couple of clients now asking for more local infrastructure in the UK, which has been difficult because actually, and we've written to the government on this point, we haven't perhaps had, or local government hasn't had a seat at the table when some of these bigger infrastructure deals have been auctioned off to global sovereign wealth funds and the like. So we've made our claim, particularly now that Boris et al. Would like us at the table. And a couple of our clients do have now local infrastructure projects themselves where we've used our asset management partners to find either modular housing or social housing or renewable sources of energy generation in some of our geographies. I mean, we're slightly blessed that I run money for mainly local governments are in the southwest, so on the coast, which is much more suitable perhaps for wind generation than some other geographies. So we are finding opportunities where our clients would like them to, but they really drive how much they would like to allocate to any particular asset class.
And just getting back to some personal reflections now, we talked about your career story. Were there any setbacks or challenges in there that you learned lessons from and to take with you now?
Yeah, undoubtedly. I mean, I don't think there's been one main thing that I can point back, but what I've learned over the years is, I guess, that you're never as good as people proclaim you to be when your performance is very good. And you're certainly rarely as bad as you feel you are when your performance is less than ideal. And so I do believe that I've yet to find a manager or even in the monies that I've run where someone can outperform all the time. And it goes back to my earlier point about depending on how you run money, managing the expectations of that return and risk profile is super important and making sure people understand that. And that's including yourself. And every time I've had a period where I've felt sorry for myself or my clients have been upset with performance, because that obviously inevitably happens over time, it's about refocusing on the long term. Like, what are we here for? How should we measure ourselves? I'm a very big believer in compounding. And I'm a really big believer in that every trade or every investment decision you make, if you can create asymmetry, that really is the key. Now, asymmetry and compounding don't appear overnight. They appear, or the benefits of it accrue over a very long time horizon. But if you can take your clients on that journey, and some of that is about setting the right expectations up front, quite frankly, I think it's a much more successful way to manage money and to have relationships. Now, I've managed money for people who have, and do today, I guess, the longest time horizon. Sovereign wealth funds in my previous life and today in the LGPS world where they don't have, that pension funds are still open. And yet, whilst they're very long term, they're controlled by counsellors or directors or trustees in my previous life who are people whose time horizons are different because they become emotional, as we all do. And trying to strip out that emotion, part of that is telling them what they could expect in certain scenarios. So if those unpleasant scenarios occur, they have put some thought into how it would feel, what they would like to do. And there's been a number of things, small things over my career that have reinforced that opinion.
And I think, I may be wrong in this, but that Brunel was recently a signatory to a charter in the UK which focused on diversity within asset managers. Exactly. So just in terms of that aspect of the ESG, can you give us your thoughts on the diversity of the investment management industry today?
Yes, I mean, it's not great. I think that's the first thing to be open and honest about. I'm sitting here as an oldish, whitish, male-ish person. I'm a beneficiary of that. My name's David, and I was gleefully informed by someone recently that there are more Davids in asset management than women. And so I'm in that respect, I'm probably part of the problem. And it's about what we do around changing that, actually, and bringing in diversity. Because when you build an investment team, you want diversity of thought. Absolutely. You want challenge. You want people who think differently. And an easiest way to get people who think differently is people who have had different experiences, learned in different places, had different life experiences or even work experiences. And so diversity, however one wants to characterize it, is really necessary in an investment team. Otherwise, you get groupthink. Now, we are currently looking at what we can do to change or use our influence in the industry to change that. And so we're looking at mentor outreach programs in our local area, but also in London. I used to do something with the Amos Bursary project. And it's about changing, I think, somewhat the perception of the industry, because you can want to change yourself. But if the perception of the industry stops people even coming to your door, it's a really difficult thing to eventually change. And so we are speaking and reaching out to people who perhaps maybe don't think that the asset management or the financial industry more broadly is for them, and trying to let them know that it is, or that it could be. And so really trying to get as much as we're able to a grassroots situation where people understand that the investment industry perhaps isn't as they've heard. Perhaps it could be a place for them, or they could find a place within the industry and all the various things that people in our industry do. And it's about, making an outreach to try and change it at that level, because you can want to change your own organization, which is one thing, and you need to understand your own biases when you recruit. But if the people who apply for the jobs you put on offer are undiverse to start with, it's a very difficult thing to do. So we had to reach beyond just our own recruitment process and try and look at the wider industry.
And it's funny, I would think that even your headquarter location in Bristol is probably something diverse in itself, because some of the junior staff you might attract there, even though people can now all work remotely, may have come from different regions of the country, outside the fray of the city perhaps. And even that probably contributes to diversity of thought.
It does a little bit. And I think what's undiverse about Brunel is what I mentioned earlier, that everyone has come here because they want to work in finance perhaps, but they want to work with a passion and they want to work with a purpose. And so it's interesting, when I first inherited the team and conducted a stock take, as it were, that came out so loud and clear. We have people who used to work in the city and didn't like the behaviours that they saw, which we know do exist, sadly, still in some institutions. We had people who wanted to invest in or work in sustainability, and this was the outlet they found in finance. We've got people who never wanted to work in the city, always wanted to stay in the southwest, and we were an option for them. And so, we've got people who come from all around the country actually and have a wealth of different experiences, some originally from the LGPS background. So they've always worked at the partner level within the funds themselves that then got taken into Brunel when Brunel was formed. So I think we do have diversity of thought, not as much as I would like. Again, we're certainly not perfect, and we launched the charter. We were a co-founder of that, and it's led by Helen Price, who's our stewardship lead. And we're very proud to do that, but it's a long slog to change, not just Brunel, but obviously, as I said, the wider industry as well.
And when you look back at your own career, did you have any mentors or key people who made an impact on you?
I think almost everyone I've met in finance has influenced me in some way, perhaps. And quite honestly, I remain open to being influenced today. I think it's the nice thing about being investments is that you're never done learning. And quite frankly, the moment you think you know everything is the time when you'll get knocked on your bottom. I don't think I've had a mentor, one that I've worked with closely. I've had some that I've worked with without being too indiscreet, that I've learned things that that one shouldn't do. I started in 99, so I've seen some pretty unpleasant bear markets, and I've seen the emotions that can run through investment firms during those periods. And so by the time I got a lead seat, as it were, I'd experienced some of the worst crashes we've had on record. And I'd seen some of the behaviors that I think were non-conducive to running money, both at a client end, but also at an asset management end. I think the people who have influenced me are people that perhaps I've read or learned from at a remote distance. So if I think about people who have been successful, but actually don't, not so much investment success, but just write in a very nice way. So there's some obvious people I've read. I always have read people like Howard Marks, Jeremy Grantham, kind of industry luminaries like that, who I've always found have a good turn of phrase, but always get you to ask the right questions. I don't think always I've had the right answer, but they ask the right questions. And that's, I think, always been very important to me. My view is this: how do I challenge it both internally and externally? And we used to have these kind of bull-bear debates to deliberately flesh out some of these things. So I'm a voracious reader. I'll read anything from anyone, certainly if it challenges my view, because I've always felt that if I can't defend my view in a robust way, then perhaps I should lessen my conviction in the view that I had. But I've never really had one person in a pure mentor way. I guess I've been heavily influenced also perhaps by people in the behavioral sphere. So people like Daniel Kahneman, again, I've only met him once, and that was at a conference. So he's not a mentor in that respect, and he wouldn't know me from Adam. But that type of work has influenced me. And so it's more their bodies of work than people perhaps that have been my existential mentors.
And that's exactly the point of this podcast series, is to get some more content out there to provide more influence and more leverage, because I do think that we can't in our own careers ever expect to touch as many people perhaps as could potentially give us inspiration. So thank you for allowing us to leverage that through that. So just coming to a couple of closing questions, was there any piece of advice you've heard that has really stuck with you, or any creed or motto that you live by?
Yeah, if I think piece of advice, it maybe goes to my character a little bit, but one of the best things I've been told was actually by someone, a very young member of one of my early teams. And so he was almost a reverse mentorship. He suggested that we should keep a diary as to the decisions we made, why we made them, the environment in which we made them, and then we should review them. And in that way, we would never let the outcome be a determining factor in our perceived success. And the reason I bought into that quite so heavily is I'd been very aware that I had made some decisions along the way, certainly in the depths of the global financial crisis, where we'd bought stocks that had gone on to do very, very well. But the reasons we'd bought them, or the rationale we'd bought them through, actually hadn't come through. And there were other drivers to that stock performance. But it's very easy to pat yourself on the back when the outcome is good. It's much harder to go back and say, did I make the right decision? And that was really useful. And that was from somebody who was, again, he was a very intellectually curious young man who I was very open and willing to learn from, or at least take his ideas on board. And I've kind of lived by that ever since. So I still keep a diary about what I'm doing, why I'm doing it, how I'm feeling, so I can put some contextual information and try and strip out my own biases where they exist, and put in some information to keep me honest and humble. Because it is easy, and it's not disingenuous, but it's very easy to take the plaudits, even if you've made a decision that perhaps the outcome was a good one, but it didn't go that way because of the reasons you forecasted. And I think that just keeps you honest.
Got a great quick practical question because I'm always intrigued by this. Is this actually the kind of old-fashioned moleskin notebook with handwritten notes, or do you keep a OneNote folder? How do you do that?
It used to be, and now I've upgraded. I've got to know where I thought, you know what, I should probably catch up. So now it's all logged on my iPad. Obviously, other devices are available, and I've got myself a pen, and it's all logged. In that way, actually, as I've got older, my handwriting's deteriorated, but it's all in one place now, and I can read, I can scroll back, and I can see the sequencing of events and the sequencing of the thought process. So yeah, it's all stored away on my iPad.
That's great. And then you're going to give us a creed or motto.
Oh, I was just going to say, for me, maybe not a creed or a motto, but if you can define success and honestly manage expectations, I think that's the key to great relationships, both personal and business. And I think that keeps everyone on the even keel, because as I said, there are many people in the asset management supply chain, from asset owner to trustee to asset manager, who can make a decision that is detrimental in the short term or in the long term, perhaps, to performance when emotion gets involved. So setting those expectations and being honest about what you can achieve, what the market can achieve, and not promising too much, and warning people that when times are good, there might be some bad times around the corner, and just making sure everyone understands what success looks like is super important to me.
And would that be your advice for your younger self? Or would you have something else to say to that young man coming out of Essex?
I would probably tell a younger me that meditation is for me. So over the last number of years, on the advice of someone who I trust a lot, I started meditating. And before I started, I probably had the vision that lots of people have, that it isn't for me and it's slightly an unusual thing to do. But I found it to be a remarkably calming thing to do. It gives me at least, some space. It clears my mind a little bit, because every day you're obviously dealing with new challenges. And so you do need to find a quiet space in your mind or in your day to do these things. But yeah, I wish I'd have taken it up a long time ago.
Well, I'll say, David, listening to you has been like a meditation for me. Your calm approach and your clear analysis of our industry and your steady hand at the helm of Brunel, I couldn't think of a better fit for the long-term needs of our local government pension schemes. So thank you so much for coming here and for sharing your insights with us.
Not so, it's very kind. Thank you.
I'm Aoife Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.